Hello. Thank you so much for taking time out of your day today. I'm really excited to share this information with you. My name is Dave Stanfield. I'm a certified financial planner professional and I'm an enrolled agent. I have that designation. Today I'll be presenting the webinar that I wrote titled Creating a Financial Plan and Investment Strategy and Dave's Top 10 Ideas to Increase Wealth Long Term. So when writing this webinar, I thought very carefully about what I think are the elements of a financial plan, all the different elements, and of an investment plan. I also thought about what I thought would add the most value, what are on the minds of my clients, and the top questions that I get, and I wrote it from that perspective. So I truly believe that if you follow the steps here and implement some of the topics that we discuss in this webinar, it can make valuable long-term effects on your long-term wealth. The presentation length's about 30 minutes, maybe a little bit longer, so please take notes and keep this. My hope is that you'll keep this presentation as a guide for future planning. So I know your time's valuable, so let's go ahead and get started. Now before I get started, I just wanted to tell you a little bit about me so you know who I am. I grew up in the Seattle area. I attended University of Washington. I received a bachelor's degree from the Foster School of Business at University of Washington, and since that time, I've worked in the financial services field in one way or another. I started my career at MetLife on Mercer Island, Washington. I worked there mainly focusing on life insurance cases and investments and annuities, and then from there, I went to work for KeyCorp in Bellevue and worked on a trading floor environment. There I serviced corporations and municipalities. We offered fixed income alternatives for short-term operating cash. And then I went to work for Fidelity Investments, and my title was Financial Planning Consultant. And over the time at Fidelity, I worked with thousands of clients and oversaw roughly $290 million of assets. And there we focused on retirement planning and building customized investment portfolios and discussed many elements of financial planning and so on. Then in 2015, I created my own company, Evergreen Wealth Management, and there were a few different reasons for doing that. But one way that I measure my success is the success of my clients. And what really drives me and gets me up in the morning and motivates me is that I know there's so many excellent ways and great things to discuss for financial planning. And now I have the time to really work individually with each client and try and implement those strategies. So I think that if we make certain adjustments, it's possible that it can make significant long-term effects on your wealth, and it could pass on for generations. So that's really what gets me excited. And then personally, I grew up in the Pacific Northwest. And my wife Irene and I, we have two beautiful kids, our son Egan and daughter Eleanor. We love to travel, and we enjoy real estate investing as sort of a hobby of ours. And I'm also a private pilot, and we fly small planes when I have the time. So, okay, we'll get into the agenda here. All right, so again, like I'd mentioned, we're going to discuss the elements of a financial plan. So what goes into a financial plan? We're going to do a deep dive on investing, because that's one element of a financial plan that is obviously talked about very frequently and an important part. Then we're going to get into my top 10 ideas for optimizing your overall plan. And like I mentioned, it's going to be roughly 30 minutes, a little bit longer. So okay, so I created this webinar. I mentioned this earlier, but based on the top questions that I get. So my goal is to educate anyone on topics I feel clients are most interested in, and then just give you sort of an outline for a financial plan and investment approach. So at the end of this webinar, or you can review it a few different times, but you'll be able to refer back to it and look at the different sections within a financial plan, and then help narrow down your choices and then choose a suitable investment approach. And then one common theme through this presentation is that I want to motivate you to take action. I'm really big on that. I want you to take it to heart, just because I'll share with you more about my experiences with that, but just witnessing so many clients over the years, that's one key pitfall where if you don't take action and you don't make a change, tomorrow something is going to be exactly the same way, your situation, and weeks go by, months go by, years go by. So that is such a key element here just to motivate you to take action and move forward. Okay, so do you have a plan in place? If not, that's okay. You're in the right place. My hope is that you're going to save this webinar and use it as a guide, for creating a plan, or helpful for an outline. But we're not going to cover everything, but you'll have a good idea of the various elements that are involved. And at the end of the day, you just want to have something written down, a written financial plan. So whether you're in the accumulation phase of your life, in your 30s, 40s, and you're just saving, it could be something as simple as just where you are today, how much you're saving, into what accounts, etc. Or if you're retired, just having a written plan where you know exactly where your income's coming from over the next several years, your investment strategy, your income, and so on. Just if someone were to ask you, hey, what's your financial plan? What's your investment strategy? You can articulate in a few sentences, this is my plan. That's really the goal, and for you to have a plan and to understand all the working elements of it. All right. So the elements of a financial plan. These are the core elements. So the financial statement preparation and analysis, and that's going to include cash flow, budgeting, and so on. And we're going to go through each of these in detail, by the way. So insurance planning and risk management, employee benefit planning, investment planning, income tax planning, retirement planning, and estate planning. Those are the core elements of a solid financial plan. All right, so the first section, financial statement preparation and analysis, what that entails is creating a statement of financial position or a balance sheet. That's kind of the starting point. Just gathering, all of your assets and liabilities and organizing it. Then creating a cash flow statement and identifying opportunities and challenges as it relates to flows in and out. Creating a budget, that's a really big one. We don't really know, what our net income is, coming in, and what our expenses are. It's hard to set goals for saving, or if you're retired, to know what expenses you need to cover in retirement. These are the key steps for creating goals, and like I mentioned there in the last bullet point, without knowing a starting point, we cannot create suitable goals for debt pay down, establishing emergency funds, creating retirement savings, and so on. So an important step in the financial planning process. Okay, insurance planning and risk management. Risk management process and the main techniques. A lot of different risk management steps to consider. Analyzing and evaluating risks relative to auto, homeowners, earthquake, health, disability, long-term care. We want to review your life insurance options, including term, whole life, and universal life, whether you don't have insurance and you just need to choose a product and reviewing them, or maybe you have an existing product that you need to review. We can help with that. Review current policies and identify opportunities, perform an insurance needs analysis, and then implement changes. So those are the kind of the core areas of insurance planning and risk management. Okay, employee benefit planning. We want to review the various options available to you through your employer. A lot of times clients aren't even aware of all the different things that they have that are available to them that they could be taking advantage of. So we want to gather all that data and analyze it. We want to distinguish between the employer-sponsored plans, including 401As, 403Bs, 401Ks, 457s, a lot of different types of plans out there. Which one do you have? Oftentimes I see clients over the years, they have several of these, from different employers, and how do they all work together? Pension benefit options, that's a really big one we spend a lot of time on as people approach retirement, or maybe have a pension benefit from a former employer earlier in their career. Insurance benefit options, including life, disability, and health. A lot of times, through group plans, group disability, group life insurance, those are some nice benefits you can get, oftentimes more inexpensively, because they're group and have pricing advantages. Then FSAs, HSAs, so flexible savings accounts or health savings accounts, ESPPs, and stock option plans. So a lot of different benefits go along with depending on where you work, and important to analyze that. Okay, So I want to cover the basics of investment planning. Then, after we cover all of the elements of the financial plan, I'm going to go. I'm going to cover investment planning in more detail and take a closer look. But over the next 5 slides, I just want to make sure that we're all on the same page with the fundamentals of investing, and so we'll cover investment planning in some detail here. So we're going to cover these 5 bullet points. What the characteristics are of investments, some of them, the types of risks, quantitative investment concepts like modern portfolio theory, measures of investment return, and asset allocation and portfolio construction. So, and that's one that we'll cover in more detail when we talk about how to build a portfolio. All right, so when we talk about the characteristics of investments, what we're referring to is the risk-return relationship of various assets. So we've all seen this graph before, and it illustrates the lower the expected return, the lower the return. And as we move out the risk spectrum, the opportunity for the return increases, but also the opportunity for loss and volatility. So it's important to look at what asset classes you hold, but more importantly, are they the right ones? Are you taking more risk than what's necessary, or are you taking not enough risk? Maybe you have too much in cash and you're 20 years away from retirement, or alternatively, maybe you're retired and have the bulk of your assets in just a few stocks from like your employer plan, and need to approach the idea of diversifying it. So just important to keep in mind that different asset classes, of course, have different levels of risk, and important to review that. All right, so we're going to go through some definitions here. First, starting with systematic risk. What that is non-diversifiable risk or market risk that comes along from natural disasters, wars, broad changes in the government policy, or other events that can't be planned for or avoided when investing in the market. Unsystematic risk is a company or industry-specific risk that's inherent with each investment, and it is diversifiable. Interest rate risk, what can happen with bond portfolio given changes of interest rates. There's some very real risks with interest rates. Important to understand those. Liquidity risk, what that can mean is that you may suffer surrender charges or have an illiquid market for selling a security. So liquidity risk is an important risk. Credit risk, what's the quality of a bond issuer rating? There's different rating agencies out there like Moody's and S&P. Inflation risk, that can have a big impact on your expenses and the value of your assets. So the different software that I use, we can look at what if scenarios. A lot of clients are concerned, well, what if there's runaway inflation at 5% or 7%? How's that going to impact the success of my retirement plan? So important to look at. Financial risk, that's a broad term, but it can be impacted in many ways, like inability to pay for a debt or a loss of income, things like that. Reinvestment risk that may arise when a bond or another fixed income investment matures and you can't find the same yield out there that you did with the previous security that you're invested in. So just want to cover some different investment risks. Okay, so just want to cover modern portfolio theory. We'll look at the definition here, but it's a theory on how risk-averse investors can construct portfolios to optimize or maximize expected return given a level of market risk, emphasizing the risk is an inherent part of higher reward, which we talked about. According to the theory, it's possible to construct an efficient frontier of optimal portfolios offering the maximum possible expected return given a level of risk. So asset allocation, diversification, rebalancing, these are all parts of a sound and time-tested investment strategy using modern portfolio theory. So asset allocation, as opposed to market timing or other strategies, assume that for a given level of risk, there's an optimal asset allocations designed to produce the best balance of risk and return. And the meeting point, again, for the optimal risk and reward given an asset, that's the efficient frontier. Okay, moving on. So I want to cover some basic definitions here, as well as far as investment return. After-tax return, that's calculated on the basis of total returns from the asset or portfolio, or in other words, income plus changes in market value, or dividend income plus changes in market value. A geometric mean, that's the average of a set of investments commonly used to determine the performance results of one investment or a portfolio. Risk-adjusted return, in essence, that's a return risk-adjusted to see how much return your investment's made relative to the amount of risk an investment has over a period of time. Okay. So now we're getting into the income tax planning, which is that section of the financial plan to implement. We wrapped up investments for now, but we're definitely going to come back to it and go through it in more detail. So we want to, with income tax planning, important to review the filing status of your 1040. There's all kinds of schedules, depending on your situation, that we have opportunity to review and look for efficiencies. Perform an analysis of itemized deductions, interest, dividend, income, capital gains, losses from a business, rental income. So a lot of different things to review with that. Explore areas to minimize tax liability and maximize after-tax returns. Pre-tax contributions to employer plans and IRAs, Roth conversions, tax loss harvesting, managing capital gain distributions. So a lot of times we talk about what the hierarchy of savings is in retirement, and we'll talk more about that as well. All right, so retirement planning. This is one section of the financial plan that obviously we talk in great detail about, but what are the sections of a retirement planning? How do we know that we have talked about the different areas or metrics of having a solid retirement plan? So what we would do first is perform a retirement needs analysis at different stages of retirement. We'd identify the risks in retirement and create strategies to mitigate those risks. Explore ways of generating income, which we'll talk more about. Social Security planning is an important one. Do you take it at your FRA or full retirement age, or do you delay to a later date or 70? Pension planning, Medicaid planning, creating a long-term plan. We just want, like I said in the very beginning, you to have a plan in place to know exactly what is your retirement plan and have it be long term, and so we know high level, and then also of course from year to year what the plan looks like, and then we of course need to review it on a regular basis and see if there's, because things will change in your life, and we want to always try and optimize wherever we can different areas of your retirement plan. Okay, estate planning. So we want to review how the accounts are titled. So for example, joint with rights of survivorship, tenants in common, etc. We want to understand the probate process, how assets are currently owned, how they're transferred at your death, and beneficiaries and so on. Making sure that's all accurate, your primary and contingent beneficiaries, and how that impacts your gross estate. And then you want to understand the various estate planning documents and the role that they play. We're going to go through what those documents are a little bit later on, and then we want you to meet with a qualified estate planning attorney to review these things. If you don't have one, I can offer referrals, but anyway, that would be a key element. All right, so now we're going to take a closer look at investment planning. One element of a solid financial plan, and it's probably the most often discussed, is just the investment planning part. All right, how should I invest? That is a great question. There's so many strategies out there. I thought it might be a fun exercise actually just to name a few. So the other day I sat down and listed as many as I could in a short time frame that things I've seen over the years. So just to name a few. There's small cap strategies, there are tax managed strategies, there's exchange traded funds, index funds, there are age-based portfolios, actively managed funds, market timing, there's option strategies, there's short selling, hedge funds, REITs, preferred stocks, MLPs, on and on. And I should mention too, within each one of these strategies, there's different choices there. So you can see how the list can be quite overwhelming, both there. I think that one of the most and first and most fundamental questions you should ask yourself is whether you think that active management and paying a higher fee is going to be a more successful strategy than using a passive management investment strategy through index funds or exchange traded funds. So there's a lot of research out there that you can look for. white papers that's looked at that. And in general, the longer the time horizon, the fewer the active managers that there are that were able to outperform those benchmarks, like the S&P 500 or the Wilshire Total Market or the EFA index. So this is, it's an age-old debate, and it can be discussed at great length. I mean, we could do a whole nother webinar on that, but I'd say that for the majority of your hard-earned retirement savings, have a diversified, well-rounded, low-cost approach. And if there's some small percentage, whatever that may be, that you want to satisfy your, intellectual curiosity or whatever, pick one strategy and try it out. But, please do as much research as you can, ask as many questions as you can on the front end before you invest. Okay, so asset allocation, what is that? I think we covered it in some detail, but asset allocation is an investment strategy that aims to balance risk and reward by apportioning a portfolio's assets according to their goals, their risk tolerance, and their investment horizon. And the three main asset classes are typically equities, fixed income, cash, and cash equivalents. And they all have different levels of risk and return, so each one behaves differently, of course, over time. Timing the market versus time in the market. This topic can be challenging. It's easy to be tempted to be more bullish in good times and more conservative in bad times. There's also a lot of pitfalls there. I see that's part of my job in just managing the behavioral side of finance. But yeah, there's a lot of research that shows that the average investor return compared to the market over time, over different time periods, is lower. And I think that the biggest reason for a lower investor return has to do with this very point, just attempting to try and time the market. I've seen this so many times when clients will, they'll sell out, they'll think the market's going to crash, and then only to discover that it quickly rebounds a month later and rallies 20% or more before they're able to buy back in, kind of having that whipsaw effect, and then only to participate in another downside. So just kind of being caught in that, getting in and out of the market, and that can be very, very detrimental to the long-term performance of your assets, and a very real and important risk, and something to try and avoid. If that person would have just remained invested along the way and not made any changes, I think they would have been much better off, and could have mitigated some of those risks. So these impacts, like I mentioned, they can have very significant impact on your success over the long term and of your overall financial plan. Important risk to evaluate. Okay, so steps in building a portfolio. Let's talk about that. So asset allocation. The first step would be to choose your desired mix of stocks and bonds for each account. So what is that for you? Maybe you're in retirement and 70-30, the 70% stock, 30% bonds. That is your desired mix. The next step is choosing your sub-asset allocation. So within the domestic equity, for example, what amount should you have in large, mid, small cap? How much in value versus growth? And also within foreign and bond allocation, or even cash, having the sub-asset allocation looked at. Then choosing individual securities, picking the selection, what type of things do you want to invest in? Is it stocks, mutual funds, exchange traded funds? Are they active or passive? And then building that out. And then choosing a platform, like what investment platform to use, and then implement that strategy. And then of course you don't want to just set it and forget it. You want to monitor the portfolio, because things can happen like style drift, where let's say you do really well with small cap growth, and then 5 years later, if you never touched it, that could be much higher exposure in that area than you want. So important to monitor it and then rebalance it as well to stay true with your original goal. Okay, so yeah, now we're going to get into the fun part here. Dave's top 10 ideas for optimizing your plan. We're going to cover all of these in detail. So for accumulators, those are the folks that are still saving towards retirement, creating a plan and sticking to it. The hierarchy of savings, we're going to go through that. Retirees, mitigating common risks. retirees creating a long-term income plan, and we're going to talk about some common strategies. Carefully selecting your bond and stock allocation. Don't procrastinate planning. Please do not procrastinate. Have discipline, create urgency, implement, like we talked about. Avoid common investor mistakes. Understand the fees you're paying, implementing an estate plan, considering the risk of doing it yourself, and then seeking advice. So we're going to go through all of these. Right, hierarchy of savings and creating a plan and the impact over time. Pre-tax versus tax deferred and after tax. So in general, I think it's good to first maximize your pre-tax contributions. So to your 401ks, 403bs, before the money is taxed, put that directly into, like an employer-sponsored plan. After that, you can deposit money into other tax-deferred vehicles like Roth IRAs or non-deductible traditional IRAs, or even annuities out there. Then after-tax brokerage accounts after that, and then saving toward retirement, investing in retirement. Just keep in mind this is a marathon, guys. It's in decades and decades of investing, and it's just important to have that discipline and patience. That's a difficult one, is just having patience, but just continuing this over time. Just keep in mind this is a marathon. Okay, in the distribution phase, mitigating common risks in retirement. Inflation, we talked a little bit about. There's a very important risk. Longevity, we talk about. We want to know what your family history is, and obviously the longer that you plan for, the safer it is. So instead of planning for you to live until you're 80 or 82, we want to usually for men I use 92, or for women 94. Or you could look even longer, I put it out to age 100, just to be on the conservative side, to make sure that you're doing all that you can to have your assets last that period of time. There's withdrawal rate risk. So you probably heard about the 4% withdrawal rule, or the 4% rule, where if you had $1 million, you could spend 4% of that. I think that's under more scrutiny now. People are trying to do more of a 3% withdrawal rate, but that's certainly a risk. Outliving your money is how much money you're spending each year, the percentage of your assets. Sequence of returns risk, that's a really important one. What that refers to is, in retirement, the sequence of your returns from year to year. So, for example, what if you retired in 2007 with $1 million? Then you get a 2008 right away, and you're also spending 4% of your assets. So, versus maybe getting positive returns for the first 10 years that you're retired. That can make an enormous difference. There's ways to mitigate that risk. So it's important to look at in income planning. Market risk, we all know what that is, just the stock market, bond market, etc. And then asset allocation risk, do you have the right mix there, like we just talked about, the steps in building a portfolio. Common strategies for creating a long-term income plan, I'll touch on this. The interest-only strategy, what that refers to is putting your assets in an interest-bearing investment and sort of living off the interest. That's what that interest only refers to, where one kind of downside to that is you have a lot of your money going into these fixed investments, and sometimes there can be liquidity if it's locked into CDs or individual bonds or something. Also, typically interest-bearing investments, the more conservative ones, aren't really geared towards growth as well. That may not be suitable. During doing periodic withdrawals, that's another common one. It could be something as simple as just setting up a personal withdrawal service on your account. You have $1 million IRA and you want 30 grand a year. So you fill out a form and have them set up a link with your bank account, and have the investment custodian, automatic deposit $2,500 a month, withhold taxes from your account. So the benefit to that is it's really easy to implement, and you could change it too. It's highly flexible, but one downside is that if the market's going down, like we talked about, you're selling shares as the market's going down. That's why oftentimes I see clients select more of a bucket approach, where they're dividing their assets into different buckets, if you will, that are doing different things. So you might have an income bucket and then a growth potential bucket. And so that would help mitigate that sequence of returns risk where if the market goes down, you're drawing that money from your interest bucket and hopefully have a long time frame in there, like 7 to 10 years. And after that, you've spent the income bucket down to zero. The goal is that you would have achieved an average total return over 7 to 10 years and grew your assets back to where they were, even ahead of where they were 10 years earlier. So that's a common strategy that people seem to gravitate to. Okay, carefully select the stock bond allocation for your accounts. One common misconception I see is retirees investing too conservatively. A lot of people think, oh, well, I'm retired, I'm 65, shouldn't I be in a 20% equity and have the majority in bonds or fixed investments? And I know it's counterintuitive, but actually, equities have proven to be one of the best ways to hedge inflation long term. You definitely need, it's no guarantee in the future, of course, but you definitely need some equity, in my opinion, to help combat the inflation over time. So what I see a lot for someone that's 70, that's say in their 60s, retiring, it may be closer to 60 or 70% equity if they're taking 2 to 3% withdrawal rate on their assets. So and you can look at using these different calculators and different assumptions just to see over 20, 30 years or longer the difference in what a conservative portfolio can yield versus something with a higher equity allocation that can have big impacts long term. And then I put in there a future value calculator can be a useful tool, like I talked about, to calculate the future value and give different inputs, compounding periods, etc. And that's something I would love to help you with as well. Okay, having discipline, create urgency. I had mentioned, this is my third or fourth time talking about please create urgency. It's a long-term game. It's a marathon, not a sprint. Decades of investing. Start now. Imagine the impact of saving. Sometimes for people in their 20s, 30s, 40s, it's hard for me to convey this message of how compound investing works and the time value of money. And if you start saving $5,000 a year now versus the same dollar amount, say at age 50, but where you didn't have that benefit of the time value of money to potentially grow your assets. I mean, it's just if we talked about, I could demonstrate this for you, in a private or a one-on-one consultation, but it's powerful. One of the most difficult tasks that I have, I just threw on there, is just getting people to realize this, and then in my opinion, some people it's important, other people maybe it's not important. I love working with people that make this a priority. I think that I take this very seriously, and I think that these little adjustments you can make, maybe later in life, you'd have wished that you would have spent more time thinking about that. When especially when you think about your legacy and what's going to go to your children or grandchildren, or even the charities that are important to you. So please, make it a priority. Make your investing a priority. It's very serious, in my opinion, and you can really give yourself the best foot forward by taking a serious look at these things, and then moving forward by implementing some of them. Then write down your goals and take action steps to implement. Okay, well, enough about that. Market timing versus chasing returns. Okay, I put on here, avoid common investor mistakes. We talked a little bit about it, but market timing versus chasing return, and chasing returns. It's kind of synonymous. That's just, in my opinion, I've seen so much difficulty with that, where people have missed these markets and chased returns, and there's just on and on with examples of that. So please try and avoid that if possible. Too much information may prevent taking steps towards goals. I see that all the time, kind of the analysis paralysis syndrome. And there's a lot of information out there, but you just kind of need to narrow it down, start somewhere, take action. Staying in portfolios with improper diversification. I see that. Someone just, life's busy. they leave their fund in a, their assets in a small cap growth fund, and then there's a, multiple year period where maybe the fund manager changed or the fees went up. Just not staying on top of this stuff, that can be a pitfall. Having a lack of patience. I mean, I know that that's a difficult one. It's hard to have a 10-year, look, especially if maybe there's 3, 4, 5-year periods where the market's flat. Just having the patience, just to continue to grind it out and put money away. But it's much better, in my opinion, to have a strategy, keep investing, maybe even if the market's down, so you're able to buy shares at lower price per share. And then hopefully when the market recovers, you're able to capitalize on that. And then focusing too much on investment returns and missing the big picture. I see that a lot in just with the advisor-client relationship, or I've seen people are they're really focused on investment returns, and I agree. Investment returns are definitely important. You want to have an investment, but you don't want to be so focused on that maybe you're cycling through investment companies or advisors, or you're not really focusing on this big financial planning picture. That can take a lot of energy, just being hyper focused on just the return that you're getting from year to year. Of course, you want to compare it to different benchmarks, and you want to be achieving as much as the market return as you can. But please don't be too focused on it, and maybe have that distract you from all the other areas of the financial plan. This is a really near and dear to my heart here, understanding your fees and potential impacts of those fees. A lot of people, they're not even aware really of what an expense ratio is. What is an expense ratio? That's something that comes out of the return of an investment within like an exchange traded fund or a mutual fund. That can range quite dramatically. I mean, it could be just a couple basis points, 1, 2, 3 hundredths of a percent, or it can be in the 2-3% range. So please know, you should be able to know that question too. What is the average expense ratio of the portfolio right now? You should be able to have that one at the top of your head. It's 0.86 or it's 1.3. So let's analyze that. Make sure that you know what you're paying. There's loaded funds out there, where common want to be an A share. So you take $100,000, you put it into a fund. It's an A share fund. So 5% is a common load that goes into the investment to the investment company or the broker, and then 95,000 gets invested. Or there's B shares where there's a contingent deferred sales charge. So if you invested, the 100,000 goes in, but you have a 5% fee if you sell it the first year, 4% the second year, and so on until that's gone. There's also C shares that can also have contingent deferred charges or higher internal expense ratios. So know what you have. There's miscellaneous fees, transaction fees, account fees. So add it all up. There's really 3 layers. There's the expense ratio, or even more. I mean, there's advisory fees if you have a professionally managed account. So you just need to be able to add up all of those different fees and total it out. Know exactly what you're paying. So do you know exactly what you're paying? Because the impact of an additional 0.5% or 1%, compounded over time. I mean, if you do the math, on $1, $2, $3 million over 20, 30 years at 1%, what kind of an impact can that make? I mean, it can be enormous. So please, be aware and know what your fees are. Okay, implementing an estate plan. Documents you should have are a will, durable power of attorney, trusts potentially, healthcare directives, and within that category, there's 2 main documents. The first is a living will, which is a statement that provides instructions for your health or healthcare if something were to happen to you. And the second is a healthcare proxy, and what that does is designates a person who's going to make medical decisions for you. So a difference there. It's also important to name an executor. Someone who's going to carry out your wishes upon your death. And another thing I see a lot is just for families with minor children, is to name a guardian in the event that something should happen. So, in general, I would just advise you to set up a recurring time based on the suggestion of your estate planning attorney for when they advise to meet again and how frequently. They may just tell you to contact them if something changes or if you have another child or get a new asset or sell an asset. But in any case, just have a plan to review it regularly. The reason I say that is because very often I find, someone sets up these documents when they're get married, for example, when they're in their 30s, and then they have, children and they move 3 times and acquire and sell a variety of assets, and really it's just a document that sits in a file cabinet. So yeah, I would encourage you just to set up a recurring time to review it on a regular basis, and if stay in touch with your estate planning attorney. If they sell their practice or go out of business, you can find another one. But just those are some good steps on implementing an estate plan and staying on top of it. Okay, consider the risk of doing it yourself. A lot of times I see these are sort of the things that why people decide not to hire an advisor. They don't want to give up control. I see that maybe it's just they just can't give up that control. But please consider that risk of not giving up control. I mean, do you have the knowledge, the expertise? So that's kind of the next bullet. But don't where in that fourth bullet point there, you don't have the time, interest, knowledge, expertise, and discipline. You have to just be real with yourself. Do you have those things? A lot of times it's ego. People don't trust their advisor. There's a lot of different examples of the risk of doing it yourself. Like I remember there was a situation where that's probably been several, where people have a company stock. There was one in particular that I can remember where there was some negative news that came out about the stock, and this person's stock lost 70-80% just within a matter of a week, and they had the majority of their savings in that particular stock. Or people staying in cash. I've seen that where like back during the crisis of 2008. And around that time period, people, just got out of the market, and then I'd call them every year, 2010, 11, 12, still in cash, the market's rallying. It's just, that can really, there's big risks with that. And then, other risks, I'd say that just please consider the risk of not hiring an advisor. Mistakes can be, it's very costly. It's tempting or easy to do nothing, and if you feel lost or you just don't want to be judged or deal with it or whatever. But please consider there is a risk to everything, in my opinion, including the choice of doing nothing. So please consider those risks and the risk of doing it yourself. Seek advice. Please don't let years go by. One of the biggest mistakes I see, we just talked about it. So also, I want to cover what is a certified financial planner professional and why work with one. What that is, a certified financial planner professional is a person who's gone through the process, administered by the CFP board, and met, in my opinion, very rigorous professional standards, and they've agreed to adhere to the principles of integrity, objectivity, competence, fairness, confidentiality, professionalism, and diligence when dealing with clients. They've also completed or undergone extensive training. There's experience requirements, and they're held to rigorous ethical standards as well. So more information can be found online for you to get more detail about that. I want to cover what is a fiduciary as well. That's a key term that has been going around lately. Certified financial planner professionals also have standards of conduct and duties owed to clients as what they call a fiduciary duty. And it says that at all times when providing financial advice to a client, a CFP professional must act as a fiduciary and therefore act in the best interests of the client. And there's a duty of loyalty to follow client instructions. And there's much more information on this topic by reading about the Code of Ethics and the Standards of Conduct. There are documents out there. So I encourage you to look into that. I also want to cover, there's a document out there I think that gets updated just about every year. It's called the Vanguard Advisor Alpha. And what Vanguard is attempting to do in this article is quantify the value in terms of a percentage that you can potentially receive by working with a comprehensive wealth manager. So The areas that they look at are asset allocation, cost-effective implementation of investments like expense ratios, implementing behavioral coaching and others. And they estimate that the total potential value that can be added is about 3% in net return. So I encourage you to look over that, any other documents that support that idea. Just keep in mind, you don't have to hand over your entire portfolio the first day that you meet, with an advisor. I mean, you can get um, there are ways to get independent fiduciary advice without investment management, through hourly billing or planning fees. But the important part is just to start somewhere. Okay, we're wrapping it up here, guys. Thanks for hanging in there with me. So misconceptions about hiring an advisor. You think you may not have enough money. You think the fee's too high. You don't know where to find a good advisor. You may not want to be judged for lack of knowledge. There's many other, but I would just say if you try, you're gonna find someone, and to please take action. There's a lot of people that offer complimentary consultations. If once you meet with a few different advisors, I think you'll gather more information, you'll have more confidence, and please, I can help. I would love to be that person to offer you a complimentary consultation, and we can go from there. So, but I think those are misconceptions more than anything else. Okay, so we want to add it all up and the takeaways. Um, Planning can help. I think we've learned today that there's ways to mitigate certain risks. There's ways to optimize growth opportunities. And we want to assist in transferring assets to the next generation through estate planning and meeting with qualified estate planning attorneys. Just think about that Vanguard Advisor Alpha. It could be roughly 3% by having the proper asset allocation, cost-effective strategies, rebalancing that behavioral coaching element, or that I was mentioning, the behavioral finance part. So yeah, add it all up. I think that's kind of the main theme there. And so how to reach me at get started today. Here's my different contact information, my office cell. You can, my cell phone is typically the best way to reach me. You can email me there at thedave@ewealthmanage.com. There's an appointment scheduling tool on my website. You can just go ahead and schedule. I think it's for 15 minutes on my website. But if you were to send me an email with just the word webinar in the subject line, then I would be happy to schedule. I love working with people where this is a serious to them. They have a sincere interest in improving or looking at ways to improve their financial situation. So please take action, and just you can reach me a number of different ways. Before you even get up from this webinar, just open up an email, type out in my email, type in webinar. And I think that you'll be glad that you did. Just send it off. It just takes 60 seconds. Type webinar in there and say that you listened to it and you want to get started and have that complimentary consultation, and we'll work out a time. So thank you so much for hanging in there with me through this entire presentation. I can't thank you enough. And I really look forward to hearing about your story and working with you. And all the best sincerely from my family to yours. All right, have a great day.